This conference will now be recorded.
Hi, good afternoon, and welcome to our fourth weekly webinar. My name is Marty Curtis, and on behalf of the advisors at Provisions Wealth Planners, I'd like to welcome you to our webinar. We're going to be running this webinar a little bit differently than we have in previous weeks. Previously, we've had the opportunity to see all your smiling faces because we had the cameras open for our guests, advisors, and our clients. And but we wanted to have the session as interactive as possible and thought the visual aspect was significant to that. We've also been recording the sessions, and when we did that with audio and visual, both on the same file, it was just simply too big to convert and have it something that we would be able to have the file updated to our website. We want to make sure that we get to as many clients as possible. So therefore, we're going to go to this format, which you will see just a slide. It has a picture of all of the Provisions Wealth Planners advisors, as well as each week we will have information on our guest speaker. As in weeks past, we have given Glenn some of the questions that we've been presented with over this past week. He does have that. He'll address that for us. And then at the end, we'll have a chance to do the call-in or the verbal Q&A session as we have in the past. So with that, I'd like to introduce this week's speaker. His name is Glenn Dorsey. Glenn is a CFA, which is a chartered financial analyst, as well as a CAIA, which is a chartered alternative investment analyst. Glenn is the Senior VP and Head of Client Portfolio Management for Clark Capital. In this role, Glenn is responsible for the portfolio construction and clear communication of the investment strategy to advisors and our clients. During his extensive experience as client portfolio manager, Glenn has focused on helping advisors deliver great outcomes for their clients. We've utilized Glenn and his group at Clark Capital for several of our investors. I know that many of them are on the call today. So with that, Glenn, welcome, and thanks a lot for joining us. Glenn?
Well, can you hear me now?
Yes.
There we go. I started talking. Sorry about that. Thank you, Marty. Good afternoon, everybody. Thank you for taking time out to join us. Obviously, there's a lot going on in the world, a lot going on in the economy, a lot going on in the financial markets, to say the least. So I thought I'd just give you a quick rundown and try and put things in a little bit of perspective. And then, as Marty said, we'll open it up for questions. So 5 things I want to cover today is sort of update on virus numbers, and again, trying to put that in some sort of a context. Update on the economic outlook. Third thing we'll talk about is volatility that we're seeing in the market and what that means to us. The fourth would be what the government's doing, and then lastly, what Clark Capital is doing in the portfolios. So from a coronavirus update, we've got 1.5 million cases so far around the world, 88,000 deaths. And I'm a math person, I'm a numbers person. They sound like gigantic numbers, and they are. And but I always need to have a frame of reference to make sense of numbers. So, to me, we went and looked, and in the year 2016, 56.9 million people died around the world, which comes out to 156,000 people per day. So right now, around the world, we're at 88,000. So less than, just over about a half a day's worth of people have died. And I am not minimizing this in any way, shape, or form. I live on Long Island, so I'm in the middle of a hot spot. We're 30 miles from Manhattan. I get it, and it is tragic. But when you see 1.5 million numbers and 88,000 deaths and look at it on TV, you think the world's coming to an end. So for me to see it in a little bit of a context made me feel better. Hopefully it does for you as well. And then, the epidemiologists can't really seem to agree on exactly what the numbers are going to be. With good reason, it's hard to model. And so I just look at historically, we've had 13 different epidemics and pandemics going back to the early 80s, ranging from, HIV, AIDS. There's still 32 million people infected around the world. Ebola, dengue fever, cholera, swine flu, avian flu, SARS, MERS, and if you look at how the market has behaved with averaging those 13 different pandemics, 6 months after the first outbreak, stocks were actually up 8.5%. Now I know it's different this time. It's unprecedented, and it is true. And each one of those, that same statement was true, as was every war that we've had or every terrorist event. Each one was unique, and this one is very unique in the sense of how quickly it shut down the economy to stop the spreading. And what the good news is that we know the social distancing measures work. We can see it around the world. I just went and looked at new cases for a lot of the major economies, and most countries saw a peak in new cases at least a few days ago, if not longer. No notable exceptions this morning when I looked were Turkey, Russia, and Brazil, where new cases were higher, but almost every other country I checked, the new cases were lower. And if you look at something like a country like China, their new cases peaked on February 12th, about 2 months after their first case. South Korea peaked on March 3rd. The data out of South Korea is arguably more trustworthy than it might be coming out of the Chinese government. And the difference between South Korea and here is pretty dramatic too. Is that they were the gold standard in terms of flooding the market with testing capabilities, and then B, when the South Korean government suggests that people stay home, they do, whereas we weren't so good at that here. And as a result, our numbers went up longer than they probably should have. On the West Coast, it was different. California, Washington did not see the same surge that we saw in New York, and I can tell you firsthand that even after the March 16th guidance from the White House, people were still moving around here up until about 2.5 weeks ago, when the states really clamped down on it. And now suddenly you're starting to see, not surprisingly, 2 weeks later, new cases are starting to roll over in New York City and hopefully Nassau County as well, where I am. So the good news is we know that these measures work. And while antivirals are being worked on, and hopefully those are effective as well, but they come out with an economic price tag, which kind of brings me to my second point. And the first quarter GDP, we had been tracking about 3%. It's going to be lower than that. We still think it might be positive, but it's kind of irrelevant. The bulk of the damage from the coronavirus is going to happen in the second quarter. Our estimates are now for about down 15 to 20% GDP. We know we're going to get a big spike in unemployment. The February data for unemployment had been at 3.5%. The March data, which was just released last Friday, was at 4.4%. It's a big move up, but in the grand scheme of things, that's the tip of the iceberg, because we get weekly data on the number of people filing for first-time unemployment insurance benefits, and we saw an increase of 10 million over 2 weeks. That puts unemployment puts it up to 10% right there. So that's going to be a bad number. And retail sales are going to plunge, and its second quarter is going to be, we're going to see some numbers that are going to be eye-popping. Third quarter should start to be a transition period where things start to recover. We think it's going to be plus or minus a couple percent around zero, and forecasting in this environment is extremely difficult, because so much of it depends upon how quickly we're able to re-emerge from hibernation and do what we do well, which is work and spend. And the fourth quarter, we think, is a recovery quarter, and that strength will go into next year as depleted inventories are replenished, pent-up demand is unleashed, and that will happen. I talk to a lot of people around the country, and people are ready to get out. This is my fourth week working from my home office, which functions perfectly well, but I'm used to traveling. I do close to 100,000 miles a year on a plane, and I never thought I'd say this in my lifetime, but I actually miss the airport. I would gladly go through TSA right now. And there's a lot of people that are saying the same thing on a less dramatic basis. The reality is we want to go out and eat and be out in public. So once we could feel that we can do that and not have our lives in danger, which I think we're going to get to that point sooner rather than later, that will happen. But all of what I said about the economy being bad is scary, and you think, well, why would we want to own anything right now if that's the case? I think the most important thing I'm going to say today, that your takeaway, is that stocks will start going up before the bad news stops coming in. So again, stocks will start going up before the bad news stops coming in. We see it over and over again. Halfway through a recession, 2/3 of the way through a recession, stocks will start to rally and the numbers get worse. And I'll give you a good example because everybody immediately thinks of the financial crisis. And stocks bottomed on March 9th of 2009, and unemployment at that time was 8.3%. Unemployment went up right through October of 2009. That was the worst month, and that was at 10%, and that number was released in November of 2009. So 8 months after stocks had bottomed and started to go up, we were still seeing bad economic data. So the economic numbers come with a lag, and stocks are forward-looking, right? They anticipate what's going to happen. So stocks will discount what is widely known in the world, and what I just said about bad economic data and spike in unemployment, drop in retail sales, increase in corona cases, increase in deaths. We know that's all going to happen. That's widely known in the investment community. It's widely known by anybody that's watching television. That's discounted in the stock price. What also gets discounted is expectations of what's going to happen, right? And under normal circumstances, you can have a forecast. You might be a little high, you might be a little low, but you're in the same ballpark. We are not in normal circumstances now because the range of outcomes is far wider than normal because it's so much is dependent upon, again, the safety profile of when we can go out and about again. And when you have that sort of wide range of outcomes, a lot of uncertainty or fear gets priced into the market. And that kind of brings me to my third point, which is the volatility. And that we have seen unprecedented volatility in the market. And a lot of that's fear. And in our business, uncertainty equals fear, and that's what we're pricing in. Buffett says it pretty well: be greedy when people are fearful, and fearful when people are greedy. A lot of fear out there, a lot of uncertainty. How do we gauge that? One is the speed with which the market went down. So February 19th, the S&P 500 was at an all-time high, and it took 16 days to drop 20%, which is what a lot of people put as a dividing line of what is a bear market. In my opinion, bear market has a lot to do with time, not just the magnitude of the drop. In any event, record speed from an all-time high to a bear market down 20%. Also, record speed to get down 30%, which was 22 days. To put that in perspective, in 1929 and 1987, both times there was a tie. Both times it took 55 days to decline 30%. That's a breathtaking drop. We had a 5-day period where the decline in the Dow was only surpassed by 4 episodes in history. One was the outbreak of World War I. Second was a crash in 29. Third was a crash in 87. And the fourth was the bankruptcy of Lehman Brothers in 2008. So what is common out of all 4 of those episodes was that they had multi-year impacts. And World War I's obvious, lasted from 1914 to 1918. Millions of people died. And then the Spanish flu outbreak happened in 1918, 1919. Another 50 million people died. The crash in 29 was followed by the Dust Bowl and the Great Depression, which lasted 43 months. The bankruptcy of Lehman Brothers, while it seemed like it was just a short-term event, realistically had a lot more to do with A, figuring out if the financial system was going to be around, and then B, the impact lasted for years after that because banks were unwilling to lend money. The access to capital was essentially shut off. And then when it restarted, it was with a trickle. And creditworthy companies, creditworthy individuals had trouble borrowing money, and that impacted the economy for years. So while COVID-19 is scary and will have a profound impact on the economy, we think its impact is measured by months, not by years, like those other times where the Dow dropped so much. Volatility can also be measured by the CBOE Volatility Index, or VIX. That has been around since the beginning of 1990. And through today, there have been 7,626 trading days. And of those 7,626 trading days, only 3 times in history has the VIX closed above 80. And just for those of you that don't know the VIX, it's the volatility getting priced into stocks. So usually when stocks go down, the volatility getting priced in goes up, which is so stocks go down, VIX goes up, which is a lot of times you'll hear it referred to as the fear index. And we just saw that on March 16th. The VIX closed at 82.69, which was the highest ever for the VIX. What that says is that on that date, 3 weeks ago at this point, that was the largest amount of volatility being priced in the stocks in the last 30 years. That's astonishing. That's an excessive amount of fear. The last time it closed above 80 was November 20th, 2008, right in the middle of the financial crisis. And 6 months later, the S&P 500 was up 20.1%. What we have seen now is the stocks have been trying to find a bottom. We're up over 20% now from the low on March 23rd. The VIX is now down to about 43 and change, way down from its high, but that's still a very elevated level. More, and the longer term average for the VIX is sort of 20-ish or under. So we're still at an elevated volatility level. And in fact, if you look at since the stock market peak on February 19th, we've had 34 trading days through yesterday. 29 of them saw the market move by 1% or more, up or down. And that is pretty significant because usually in a year you get about 63 days like that. So we had 29 out of 34 days. Matter of fact, we can make it 30 out of 35 days now because we just had another 1% move in the market. And 9 of those days had a move greater than 5%. That's a lot of volatility. So these swings back and forth are going to last for a while, even as the market's trying to find a bottom. Volatility, which can be good or it can be bad. Today is good volatility, right? We're up 3.41% on the S&P, but that's going to last for a little while where we seesaw back and forth. The other thing that we saw that indicated a lot of fear was just the amount of money that came out of not just stock mutual funds, but bond mutual funds too. In the week ended March 25th, the Lipper data showed that $16 billion came out of stock mutual funds. $62 billion came out of taxable bond mutual funds, and another $13 billion came out of municipal bond mutual funds. We're getting a lot of questions, and I know that some of what Marty sent over relates to what we're seeing in the bond world. When you get that amount of money, and those were both records coming out of taxable bond funds and municipal bond funds, when you get that kind of pressure on redemptions, and when people take their money out of mutual funds, the portfolio managers that manage those funds have to sell to raise the money. That creates tremendous dislocations in the bond market, and there's a lot of selling pressure. And it's an interesting time period because it creates a lot of opportunity for us. We own individual bonds, so we're not pressured into selling bonds unless one of our clients wants their money back. So generally speaking, it's an opportunity for us to bargain shop, and we did that as much as we could. We saw some cases municipal bonds that were AA rated, and there's something called pre-refunded or pre-muni bonds, where the issuer actually has another bond issue. They buy treasuries to assure the repayment of principal or par value back on the original issue. So you're essentially secured by treasuries, which should be pretty high quality. but many instances we were seeing these pre-refunded bonds trade at 2.5 or 3% higher yield than treasuries, which makes absolutely no sense whatsoever because they're backed by treasuries. So we're seeing a lot of that. Some better companies have come to market to take advantage of the situation. We've been trying to buy the deals there where we can take advantage of it. But there's a certain element of there was, and it's eased up quite a bit recently, but there was a lot of lack of liquidity in the marketplace, and we had a situation where the client did need some money, and one of the bonds, they had a municipal bond, and we put it out for bid and got a bid of 80 and we didn't want to trade it there because it was a ridiculous price. The next day it was 98. So that makes no sense. There's a lot of that indicates to us a lot of lack of liquidity in the marketplace. But again, just looking at the fear that we saw or have seen in the market, and it's dissipated a little bit. Speed with which the market went down, the huge record level of volatility as indicated by the VIX, and then kind of indiscriminate selling when people are dumping bonds, which are their safe asset in theory. If you look at the Barclays Aggregate Bond Index, which is kind of like the S&P 500 for bonds, which started back in January 1, 1976. There have only been 3 calendar years where you lost money in the Barclays Ag, and the worst year was 1994, and that was down 2.92%. Like that shows you the level of difference in volatility over time for bonds versus stocks. So again, we've seen what was definitely panic. It's abated a little bit, but we certainly saw high panic levels, which are you typically see in a bottoming process. The fourth thing I want to cover is what the government's doing. Monetary policies, the Fed. The Fed acted quickly and aggressively. They cut rates to basically 0% on Fed funds, which is where they were in December of 2008. They're buying back assets, unlimited amount of treasuries, unlimited amount of mortgage-related agency bonds, which quantitative easing is what that's known as. They're buying commercial paper, which is what large companies use to finance their short-term cash needs. We're also buying short-term municipal bonds and short-term investment-grade bonds. So they are out buying a lot, and in over a 2-week period, they'll have bought more securities back than they bought in 7 months during the financial crisis. So they took the financial crisis playbook, which evolved over months and quarters, and condensed it down to a 2 or 3 week implementation period. It's pretty impressive. So that monetary policy is $4 trillion plus, which is a lot of money. On the fiscal policy side, there's the House, the Senate, and the White House. They passed their third virus relief act. I think I'm losing track of time, but I think it was it'll be 2 weeks ago from this Friday, which was a $2 trillion plus package to extend unemployment benefits to people, to provide loans to small companies that if they're used for payroll and utilities and rent will turn into grants that don't need to get paid back, loans to larger companies and industries that were impacted, and checks directly to taxpayers for, depending upon income, a couple could get a $2,400 check plus $500 for each child. So if you put $2 trillion fiscal policy together, $4 trillion of monetary policy, that's a lot of money, even for a $20 trillion economy. It's 30%. And what inevitably we'll see is what we always see, and I've already seen it a little bit now, is that you'll have the doomsday people trot out on television and say, oh, look, the government can't do anything. The Fed cut rates, the government's spending all this money, and the economic data is still getting worse. And I've seen that. I've got news headlines that go back 6 decades that are basically saying that the world's coming to an end and the government can't do anything, and we're in this death spiral in the economy and we're heading to depression. And the economic numbers, I already mentioned, come with a lag. So it's true to a degree. The economic numbers will get worse, but we'll start to see improvement in companies' order books and way before we see it in the economic data. And you'll certainly see it in stocks beforehand as well. But where they'll be wrong is that it ultimately doesn't work, because 30% stimulus is a lot of gasoline on the barbecue grill and doesn't take much of a spark to get a really big flame, and that will happen. The last thing I just wanted to touch on before we open it up is that, when you're doing financial planning, Marty or her team, we know that stocks are volatile. On average, you get a 20% correction every 3 years. This happened to have gone down almost 34%. But it's not unprecedented. So when you have a volatile asset class like that, you use it for long-term planning needs, because we also know it's the best performing asset class over time. Where you don't want to be caught is in a situation where you have to sell something that's down to fund something, which is why typically you use bonds or other strategies like our fixed income total return strategy that has less volatility to take care of short-term needs. So just know that when you see the stocks or bonds, or the Dow or S&P 500 up or down a lot in a day, typical portfolio is not going to be down as much, and that's really important to know. Our fixed income, our fixed income total return strategy was in high yield bonds up until February 26th, where we went 50% into treasuries, and then on March 9th went all the way out of high yield bonds into treasuries, high grade bonds, to preserve capital. It did that, did far better than the high yield index over the period where we're de-risked. Our model got us back into high yield bonds on March 27th. It's had a history of doing that successfully. It did it in 2008, where we had de-risked, actually had a positive return in 2008 before fees, and then participated in the big bounce back in 2009 as it got back into high yield bonds. Did it also in 2015 and 2016. Stock prices were going down, bond prices were going down, oil prices were cratering. We were in treasuries from early in December 2015. Stocks, bonds, oil all bottomed on February 11th, 2016. We got back into high yield on February 29th. Yes, it was a leap year that year also. And we participated very nicely as high yield bonds started to normalize through the rest of 2016 and into 2017. So similarly, hopefully, knock on wood, that's what just happened as we went back into high yield started going back on the high yield on March 27th. We've been tax loss harvesting where we can to offset gains that we might have taken earlier in the year when stocks were up, and hopefully when to offset gains we're taking later in the year as things go back to normal. That's an important technique that we have used to lower tax bills. And then inside the portfolios, back in January, we were reducing travel and leisure-related holdings, things like airlines and cruise lines, which sound pretty obvious that you would not want to own right now. We were getting out of those in January. We also were reducing our positions in some of the big banks because they get hurt from the rapid drop in interest rates, and there's a higher risk of defaults and delinquencies as the economy weakens. And also we've been bargain shopping, looking for companies that have good, strong balance sheets, good, durable business models that will get through this economic slowdown and come out the other side in good shape. So things in the consumer products area, food area, discount retailers, healthcare, all areas that we've been bargain shopping. And the simplest way to think about it is if you wanted to buy a business in your hometown, you loved it, great location, great product line, and you loved everything about it but the price at which the owner wanted to sell it to you for. And then something like COVID-19 comes along, their business slows down or stops, and then they'll be willing to sell you that business for 30, 40, or 50% less. If you have a longer time horizon, which is what stocks are, you're probably going to jump at that opportunity because sooner or later the effects of the virus go away. Now you own a great business that you got at a great price. That's how we view stock buying as well. So just lastly, before I turn it back over, you make your financial plans when things are calm. You're thinking rationally, intellectually. You're using the left side of your brain, which is your analytical side. And then a virus comes along or a pandemic comes along and stocks drop quickly in price, and then the right side of your brain, the emotional side, lights up, and that fight or flight instinct that humans have kicks in. And the flight instinct in terms of financial assets is to get out and to sell everything. We see it in the mutual fund numbers. And history suggests over and over again that selling into a panic is not a good strategy. I know my experience in the market has told me that. as just a broader concept. Making major decisions in your life when you're emotional is probably not a good idea either. And this is one of those times. And staying focused on your long-term game plan is how you avoid being one of those statistics that we always cite about the average investor not doing as well as the asset classes would suggest. So the only way I know to lock in a loss and not have your asset value recover is to sell at the bottom and not give yourself an opportunity to participate when things recover. So, Marty, I know I covered a lot, very quick period of time. Happy to take any questions you may have. Did I hit? Let's see if I hit all the questions. I think we talked about what we did in the portfolios. The volatility, the volatility is going to be here for a while. I guess there was a second part of that question about the election.
Yeah.
Well, the interesting part of that is we just saw Bernie Sanders drop out. So that leaves Biden and Trump, obviously, as the presumptive candidates. I think a lot of, historically, the market has liked to see the incumbent reelected, whether it's a Democrat or a Republican. When the incumbent wins, the market on average is up, I think 9.5% the next year. And if the opponent wins or the incumbent loses, the market has generally been down. I think it was about 4%. So, so that's typically what the market likes to see. Stocks don't like change, right? We always say the market can handle good news and bad news, but not uncertainty. Any change is uncertainty. The odds of the incumbent being reelected usually are highly correlated with how well the economy is doing, but also importantly, what direction the economy is going. So if we have a temporary dip in economic numbers that are on the upswing as the election kicks in, we would think that would tend to favor a second term for Trump. Not a political statement, please, everybody. I'm not making a judgment. I just go over numbers and how they affect our economy and stocks. So with that, Marty, did I miss anything, or do you have any other questions you want to open for?
Yeah, it looks like the questions that we had submitted, you certainly have covered. So thank you. I do have one. It comes up every time. So when you look at the recovery, a V shape, a U shape, an L shape, what do you think we have to look forward to?
That is a fantastic question. So usually the faster the market goes down, the faster it recovers. And just I go back to, if you look at the financial crisis, stocks topped on October 9th of 2007. They bottomed on March 9th of 2009. So that was a 17-month period where stocks went down, and it felt like about 17 years. And I'm sure anybody that was in the business or investing at that point would agree. And it took 48 months to go back to a new high. If you look at 1987, which was more of a crash or a quick drop, stocks declined over a 4-month period. So they actually topped in August of 1987 and went down into December of 1987. It took 20 months to recoup that 4-month decline. But if you look at just what happened to get back to where we were the day before October 19th in 1987, it took 13 months. So, and that's pretty typical. The faster they go down, the faster they come back. We just way exceeded what happened in 1987 in terms of speed. So if history is any guide, it would suggest a relatively quick comeback. Now, again, we just bounced over 20% from the bottom and the bottom was March 23rd. So 16 calendar days. That's a really rapid.
That's fast.
That's a really rapid rebound. It doesn't, we don't expect ever for the market to go up in a straight line. So, we're going to see fits and starts with this, but as the new cases in COVID-19 are starting to roll over, the U.S. so far, the worst new case day was April 4th. Hopefully that is a trend that continues like a lot of other countries. We'll slowly but surely start to figure out who can go back to work and who can go out and find out how many people have been exposed to this already. My guess is that it's going to be a relatively quick recovery for stocks, a little bit longer for the economy, which is pretty typical. And again, I go back to the financial crisis, right? So stocks bottom March 9th, 2009. If you bought on January 1 of 2009 or February 1 of 2009 or March 1 of 2009, you might have gone down for a little bit until you hit the bottom on the March 9th. But if you look back at the end of the year, you were much happier that you bought than sold. And if you look back 11 years later, where we would be today, you probably brag to your friends how you nailed the bottom of the financial crisis, even if you bought in January, right? So time has a way of healing some wounds.
Yeah, it sure does. Great. Hey, Bart. Bart Lansford is another one of our advisors. Bart, I know that you had some questions that were posed to you today. Have those been answered?
I turned my mic back on. Let me quick look. The only question I would wonder, Glenn, is what about the high yield bond market and defaults and that whole mess?
Yeah, that's a great question. So again, our fixed income total return strategy, it can be in one of three places: high yield, treasuries, or T-bills, or cash, if you will. So we de-risked on February 26th, we de-risked on March 9th, and then we just went back into high yield on March 27th. What happened to spreads in the high yield space? So for those of you that don't know what a spread is if you think about treasuries are quote unquote the risk-free asset, and a high quality investment grade bond, you're gonna have to get a little bit higher return on that to take any kind of credit risk, even if it's a very credit worthy. So investment grade bonds will have a little bit of a premium over treasuries, whereas high yield bonds will have a bigger premium. And what we saw is that premium went from about 3.5% over treasuries to 11% over treasuries at the worst part of the high yield market. It's back down to under 9% now. So what we're seeing is that credit spread contract. We saw the same thing happen in 2015, 2016. It didn't get quite as bad. The high yield spread went to about 8% and then went back to that more normal level of, say, 3.5%, 4%. And that period of time where things improve is really, high yield is a great place to be while it's improving. It's not a fun place when it's going the other direction. But I think it's important to look to so there's AAA, AA, single A, triple B are all considered investment grade. And when you get down into the double B plus is where they say it's non-investment grade or high yield, or the really pejorative term junk bond. But if you look at what the default rate was for double B bonds during 2008, 2009 on a global basis, the default rate was less than 1%. If you go out into the C level ratings, which is several rungs down from double B, that's where you see default risk really, really go up. So, you could be in that high yield space or non-investment grade and pick up a nice premium over treasuries. And again, we're just under 9% premium, and hopefully not have a significant risk of default in there. And this is an environment where I think, again, it really highlights active management and why you really need to understand what the credit risks are, because not all bonds or issuers are created equally, and you really want to weed out the ones that are bad.
Okay. Bart, anything else?
Yeah, the other thing was I've read varying opinions on whether growth or value is going to lead us out of this recession as far as equities go.
Yeah, so have I. There's a lot of different viewpoints. What did the worst in this on the pullback was value. And a big part of that was because banks and energy stocks were leading the charge on the way down. Theoretically, they should lead the charge on the way back up, and you've seen values slightly outperform growth on this recovery period. And that wouldn't be shocking to us because value stocks have underperformed growth stocks significantly for 2.5, almost 3 years now, and the valuation differential between growth stocks and value stocks is as stretched as it was in 1999. So value stocks look really, really cheap right now. At the same time, people that want to get their toe back into the equity market, it's safer to buy technology and healthcare is a safer way to get equity exposure, because we know that their business is held up far better on the way down. And if you're wrong on that call, you're probably gonna have less downside. But again, once the bottom is found and things start to recover, the areas that got hit the hardest, generally speaking, will do the best coming back out. But it comes with a higher risk, and that would be value stocks as well.
Thank you very much.
You're welcome.
Okay, do we have any other questions from the audience at this point? Going once, going twice. Well, Glenn, as I thought, when we get this many people on the webinar, it's typical that we don't have any follow-up questions. Part of that is people tend to get shy, and the other part is, Glenn, you just did a great job. Really appreciate
thank you.
Your insight and thoughts. I know that your time is really valuable. Everybody's clamoring for it, and appreciate you wiggling us into your calendar. Really, really appreciate it. I also want to thank all the clients on the call. Your time, you may have a little bit more time on your hands now that you can't go anywhere, but we really appreciate that your participation on the webinars, and look forward to your participation again next week. Again, we'll be at 3 o'clock on Wednesday, in which we are going to feature Eric Ristaben. He is with Russell Investments, and he is going to pretty much follow the same format as Glenn and our prior speakers have, but again, a different manager's thought and insights is very helpful. I know I've said it in the past, but we really appreciate the trust and confidence that you place in us each and every day. Know that we're working really hard these days and diligently on your behalf, and we'll certainly keep in touch with you. So if we don't have any other questions or comments, I'd like to just say thank you very much again. Stay well, and talk to you next week. And thanks again, Glenn.
Thank you. You're welcome. Be well. Bye-bye.
Bye-bye.